Welcome to the Deep Dive. Today, we are digging through an earnings report that, well, the market treated like toxic waste. We're talking about a prominent consumer staples brand focused on personal care, baby products. Their stock went down nearly 30% after its Q3 2025 call. Just wow.
It's fascinating, isn't it? That huge disconnect. Management drops this call after market close, November 5th. They're talking up this massive strategic overhaul, transformation 2.0, supposedly to guarantee profitable growth. But the street, intense, immediate panic.
Yeah.
When you see a pivot like that met with a near 30% haircut on market cap, that tells you investors are bracing for like severe near-term pain.
Yeah.
And probably big execution risk too.
Yeah.
You got to figure out why the market is just, burning the old strategy to the ground.
Okay, let's definitely unpack that divergence right now because the headline numbers were genuinely mixed, a real tale of two statistics. Starting with the good news, I guess, profitability actually delivered a solid beat. They reported GAAP EPS, that's generally accepted accounting principles, earnings per share of a penny, $0.01, which kind of surprisingly beat the consensus forecast for a loss of a penny. So that means actual net income, around $1 million. Positive.
Yeah, and that small positive net income, it sort of confirms that the operational stuff they put in place before, it's holding.
Yeah.
They also kept up positive adjusted EBITDA. That's 8 consecutive quarters now. $4 million this quarter.
Right. Adjusted EBITDA. That's the core operational cash flow before all the big investments and taxes.
Exactly. It's a key non-GAAP measure. Shows the sort of underlying health.
Okay, but, and this is a big but, that profitability beat was just completely overshadowed by the huge miss on the top line.
Completely.
Revenue came in at $92.6 million. Consensus was looking for, $99.4 million? Big miss.
Wow.
And that represents a year-over-year revenue decline of 6.7%.
Oh.
Ouch.
And if that wasn't bad enough, you had the margin compression too. Gross margin dipped 140 basis points year over year, landed at 37.3%.
Just remind us, 140 basis points is...
That's 1.4%. 1 basis point is just 0.01%.
Got it.
So the market saw that shrinking revenue plus the margin pressure and basically decided, look, the current business model, it's broken.
Which ironically sounds like exactly what management was saying too.
Pretty much.
Which brings us to transformation 2.0. So if the market's feeling the pain, management is saying, yeah, this pain is necessary to achieve what they call powering honest growth.
Precisely. This is the big move. Stop chasing, low quality revenue. The whole objective is to sharpen the focus.
Yeah.
Get it exclusively onto their highest potential, highest margin core stuff, wipes, baby personal care, and diapers.
Okay, and part one of this transformation involves some pretty serious surgery on the business. What exactly did they decide to cut?
Oh yeah, this is a substantial reset. They are voluntarily chopping off non-strategic, low-margin stuff. The 3 big exits are all apparel. Gone.
Wow.
Ending Honest.com as a direct fulfillment channel.
Yeah.
And cutting off direct sales to Canadian retailers.
Hold on, I want to clarify the DTC fulfillment change. Honest.com isn't shipping products anymore. What does it become? What's a pass-through site? How does that save money?
Good question. That's key to the savings. When they stop direct fulfillment, they ditch the costly warehousing, the inventory management, the logistics, all that stuff for shipping individual packages. The website pivots. It becomes more like a resource, a brand experience site. And it points you, the consumer, to their key retail partners like Target or Amazon for the actual purchase and fulfillment. So it shifts the cost burden, the logistics hassle, entirely onto the retailers. It improves their SG&A selling, general and administrative costs immediately.
That makes sense. And just to underscore how big this is, these exited lines, they were about 22% of Q3 revenue.
Yeah, roughly 22%.
That's not trimming the hedges. That's like removing a major limb from the company.
It really is. And the near-term financials are, well, harsh, but strategic, supposedly. Management expects this transformation to rack up some steep one-time costs, estimated between $25 million and $35 million.
Oof. That's the cost of what? Unwinding contracts, restructuring?
Exactly. Severance, write-offs, all that.
But the expected payout for taking that hit is significant, right?
Absolutely. They expect this surgical pruning to generate between $8 million and $15 million in annual cost savings starting in 2026. Comes from optimizing the cost structure, right-sizing that SG&A we just talked about.
Right. That brings up a critical point, though, flexibility. Management mentioned they have $71 million in cash, 0 debt. With transition costs running up to $35 million, is that cash buffer really enough if things get messy or if the core business stumbles?
It's tight. but probably manageable. The zero debt part is the key protection there.
Hmm.
$71 million should be enough to absorb the stated costs, but man, it requires them to execute perfectly.
Right.
Any big delay, any disruption, just getting out of 22% of your revenue smoothly, that would eat into the buffer fast. The market is definitely pricing in that risk.
Yeah.
That they might have underestimated the true cost of this, like corporate divorce.
Okay. And how did this massive planned disruption hit their financial outlook for the rest of this year, 2025?
Yeah, no surprise, they lowered guidance. As reported, revenue guidance got knocked down to a range of -3% to flat year over year. That reflects the immediate hit from the wind down.
Makes sense.
And the adjusted EBITDA outlook also took a hit, lowered from the original $27 to $30 million range, way down to $21 to $23 million.
And the market saw that lowered earnings guidance as basically proof that 2.0 means deceleration before acceleration.
You got it. Pain first.
Okay, let's pivot then. Let's talk about the categories management wants us to focus on. The organic core, this is the future business. What's looking promising there?
Right. The whole story now hinges on this organic business. That's the part excluding those big exits we just discussed. Management guided for this core segment to grow 4% to 6% year over year.
Okay.
And crucially, year to date, their organic revenue growth was tracking at 6%. So the foundation seems, sound.
And within that core, you mentioned some really strong growth stories, particularly wipes and baby personal care. These two are over half of total revenue now.
They are the undeniable bright spots. I mean, look at the delta. Wipes consumption grew 24% this quarter. The overall category grew just 3%.
Wow, 24 versus 3. That's huge.
It's massive. A key driver was that smart expansion of adult flushable wipes, moving them into high-traffic aisles at places like Target. They're getting beyond the crowded baby aisle, trying to grab more households.
That's smart shelf strategy, right? Using their brand name to get into new parts of the store.
Exactly. And similarly, baby personal care consumption grew 10%. Again, way better than the category's 2% growth. They're capitalizing on that sensitive skin market. Plus, new distribution wins, like the new character collaboration. Disney's Mickey Mouse, Winnie the Pooh.
The cute factor.
Totally. That kind of recognizable IP, it doesn't shell to parents. It gets the 2-year-old pointing at the shelf, demanding that package, drives instant sales or velocity.
Okay, but here's where the positive momentum kind of grinds to a halt.
Oh.
The major anchor dragging down that reported 6.7% decline. It's still the diaper category, still about 30% of their total revenue. And diaper consumption is down double digits. What is going on there? What are the drivers?
Yeah, diapers are the big headache. You've got like 3 major headwinds stacking up. First, management pointed to assortment simplification at their biggest brick-and-mortar retailer, meaning they eliminated the gender-specific prints, focused only on gender-neutral designs, basically less variety on the shelf.
Okay.
Second, they were lapping some huge, unrepeated promotional events from Q3 last year. That makes the year-over-year comparison look worse than maybe it really is.
Gotcha. And the third factor, this sounds like the most macro one and maybe the most painful right now.
That's the economy.
Yeah.
Macro pressure is clearly pushing value-conscious shoppers toward lower-priced items, whether that's store brands, private labels. When every dollar counts, people trade down from premium brands like this one. That phenomenon alone is hurting the whole category, not just them.
So if 30% of their business is shrinking and facing these really tough headwinds, what's the playbook? What's management doing to try and stabilize diapers?
They're fighting back on 2 fronts, product quality and price. On quality, they rolled out a new improved diaper design. They claim it's superior. And actually, consumer complaints are down 21% year over year since they did that. So maybe something's working there.
Interesting.
On price, they're tackling the macro pressure head on, adjusting their price pack architecture to be more competitive. That includes introducing a new lower entry price point, like a $19.99 option maybe,
Right.
trying to catch that value shopper.
Right.
And they're doing rollback pricing strategies at key places like Walmart. Management said that's already showing some early increases in product movement or velocity.
Okay, so that lower price point is a direct response to the trade-down effect. But if the whole diaper category is suffering,
Yeah.
is there any light here at all in this specific unit?
See, there is a critical kind of complex nuance here. Management called it the tale of 2 cities.
Okay.
The issue seems heavily concentrated in one major channel. The diaper business is actually doing okay, even, well, at their largest overall customer, which is Amazon.
Really?
Yeah, up 3% year to date on Amazon. Why? Because the full gendered print assortment is still available there. And get this, the diaper business outside of that single largest brick and mortar retailer It's actually up 5% in consumption year to date.
Whoa. Okay, so the double-digit decline is basically being driven by one major retail partner's decisions, plus the macro stuff.
Pretty much. It reframes the challenge, doesn't it? It's more a retailer relationship and assortment issue made worse by the economy, not necessarily universal product failure.
That makes a huge difference in how you think about fixing it.
Exactly.
Yeah.
Which is why the street is demanding proof, like now, that they can fix those relationships and that the new pricing actually works. Which brings us back to why the stock just cratered nearly 30%.
Right.
The market is punishing that near-term slowdown and just screaming for proof of execution on Transformation 2.0.
So what are the main risks the street's focused on now besides turning diapers around?
Well, the biggest is probably just executing those exits cleanly. Winding down 22% of your revenue without tripping up. That's a massive logistical challenge.
Yeah, I bet.
Second, they need to stabilize and then expand the gross margin. It got hit this quarter, not just by tariffs, but also by what we call volume delever.
Meaning
Their fixed costs got spread across a smaller revenue base because sales dropped. Makes the margins look worse.
got it.
So until they shed that low margin baggage, they absolutely have to stabilize the margin on what's left.
So the whole narrative just pivots, doesn't it? 2026 isn't about proving they can be profitable anymore. They kind of did that.
Right.
It's about proving consistent, sustainable, organic growth, hitting that 4 to 6% target they set for the core.
Correct. The ultimate catalyst is showing that this new, cleaner core business deserves a higher valuation multiple. They need proof they can fix diapers and get through these exits without blowing up the balance sheet.
All right, before we wrap up, let's do our favorite segment. And as always, this is purely for discussion, maybe some entertainment. We are not licensed financial professionals.
Definitely not.
This is absolutely not financial advice. Don't trade based on this.
Understood completely. But if you were sitting on an investment committee looking at the carnage of that stock drop, here is the outrageous but plausible pitch. We initiate a long position in the common stock. Right now, at the current price, was it $2.33 post-call?
Okay.
The thesis is that this price is an emotional floor. It's driven by investors just liquidating based on fear and scary headlines.
But why buy into that noise when you know there's $25 to $35 million in restructuring costs coming down the pipe? Seems risky.
Because the market right now is valuing the entire legacy business.
Yeah.
The messy parts, the low margin apparel, the expensive DTC fulfillment, the whole thing that just reported a 6.7% revenue decline.
Yeah.
So our thesis is based on re-rating the company based only on the clean, debt-free core that's left after the surgery. We're essentially buying the future business segment wipes and personal care that's showing double-digit consumption growth right now and guiding for 4-6% organic growth.
So you're saying buy the stock based on the future 78% of the business, ignore the 22% that's getting cut even though it's dragging down current numbers?
Precisely. Buy the noise now. Because once that low-margin baggage is fully gone, probably late 2026, the company pivots its story. It goes from shrinking revenue to profitable core growth. And we anticipate a significant multiple expansion then, moving towards a valuation more like a pure-play consumer staples company, making that $2.33 entry point look like you got in on the ground floor of a whole new company.
That's a high conviction call. And it hinges entirely on flawless execution of Transformation 2.0 and immediate success in stabilizing those core retailer relationships, especially in diapers. The next 4 quarters are going to be excruciating to watch for them.
Execution risk is everything here. Yeah, everything.
Okay, so to recap our deep dive, management pulled the trigger on a painful revenue reset. Goal is a higher quality margin profile down the road. Near-term reported numbers look pretty terrible, but the core categories, the ones they're keeping, they're showing double-digit consumption growth, which kind of validates the strategy, maybe.
Which leaves us with an important question for you, the listener, to chew on. Given the really extreme pressure across the whole category and how aggressively consumers are shifting to low-cost alternatives right now, how long will it realistically take for the innovation in those new diapers and that new value pricing to actually outweigh the strong macro headwinds? Is the recovery for them measured in quarters or is it years?
That's the multi-million, maybe billion-dollar question right there. That wraps up our dive into this Q3 2025 earnings call. As always, we encourage you to check out the source materials yourself, form your own conviction. Thanks for tuning in.